Imagine getting paid every single month just for owning a few stocks. No job, no side hustle, just money rolling into your account like clockwork. Sounds like a dream, right? Well, that dream is called dividend investing. And today we're counting down 3 high-yield dividend stocks that can actually put cash in your pocket every month. These aren't your typical 2% or 3% yield stocks. Nope, we're talking yields around 10% or higher. And the last stock on this list pays roughly 13% every single month. So if you love the idea of passive income or dream of retiring early, this video is definitely for you. Let's dive in. Why dividend investing works. Before we jump into the countdown, let's take a second to understand why dividend investing is so powerful. A dividend is basically a company's way of saying, thanks for investing in us. It's a portion of profits paid out to shareholders. If you own a dividend-paying stock, you'll get cash deposited into your account, usually quarterly, but some companies pay monthly. It's like getting a mini paycheck just for holding an asset. Now, many investors, especially those aiming for financial freedom, love dividend stocks because of the cash flow. Instead of waiting years for your stocks to, hopefully, rise in price, you're getting paid regularly. You can use that money to cover expenses, or better yet, reinvest those dividends to buy more shares. That's the secret of compounding. Your money making more money month after month, but not all dividend stocks are created equal. High yields often come with higher risks, so it's essential to understand the business behind the payout. All right, let's start our countdown of 3 high-yield dividend stocks that pay monthly. Stock number 3, Apollo Commercial Real Estate Finance, ticker ARI, yield around 10%. Starting off our list is Apollo Commercial Real Estate Finance, also known as ARI. ARI is a real estate investment trust, REIT. Basically, it lends money for commercial properties like hotels, offices, and industrial buildings. In return, it earns interest on those loans. With a portfolio of over $7 billion, ARRI is managed by Apollo Global Management, one of the biggest names in finance. Let's talk about why investors like ARI. High income. A 10% yield is massive compared to the typical stock market yield of around 2 to 4%. That means a $10,000 investment could bring in about $1,000 per year in dividends. Diversified portfolio. ARI spreads its loans across different property types: healthcare, mixed use, industrial, and more. This helps reduce risk. Strong backing. Being managed by Apollo gives ARI serious credibility and access to massive capital resources. However, it's not all sunshine and payouts. Dividend coverage is tight. ARI has sometimes paid out more than it earns, with payout ratios over 100%. That's not sustainable forever. Interest rate risk. Rising interest rates can hurt real estate values and increase borrowing costs, both of which pressure ARI's profits. Dividend cuts history. ARI has cut its dividend in tough times, like in 2020 during the pandemic and again in 2024 amid real estate stress. Still, for those who believe commercial real estate is stabilizing, ARI's 10% yield could be an attractive income play. Just know that this one carries some risk. Stock number 2, Arbor Realty Trust, ticker ABR. Yield around 12%. Next up, we have Arbor Realty Trust, another REIT, but this one focuses mainly on multifamily housing, apartments, rental homes, and some commercial projects. Here's why that's interesting. People will always need a place to live. Even when the economy slows, the demand for housing tends to remain strong. Arbor specializes in lending for apartments, and it also manages and services loans for big programs like Fannie Mae and Freddie Mac. Let's look at the pros. Massive yield. ABR offers a 12 to 13% yield. That's one of the highest among U.S. REITs housing focus. While office real estate has struggled, housing remains relatively resilient. More people renting means more business for Arbor. Dividend growth track record. Before a recent cut, Arbor raised its dividend 13 times in 5 years. An impressive streak. Share buybacks. Management even approved a $150 million share repurchase plan, showing confidence in their stock's value. But again, high yield equals high risk. Dividend cut in 2025. Arbor reduced its dividend from 43 cents to 30 cents per share due to higher interest costs and slowing loan growth. High payout ratio. Its payout ratio often exceeds 100% of net income. That's not ideal and leaves little room for error. Economic sensitivity. If the housing market weakens or defaults rise, Arbor's earnings and dividend could come under pressure. Despite these concerns, Arbor remains a popular choice among income investors, especially those who believe the housing market will stay stable. The double-digit yield is tempting. Just approach it with realistic expectations. Stock number 1, PennantPark Floating Rate Capital, ticker PFLT. Yield, around 13%, paid monthly. And finally, the number 1 spot on our list goes to PennantPark Floating Rate Capital, or PFLT. Now this one's special because it pays dividends every single month, not quarterly. And the yield, around 13%. PFLT is what's known as a business development company, BDC. Basically, it lends money to small and mid-sized companies, usually through floating rate loans. That means when interest rates rise, the amount these companies pay goes up, and PFLT earns more income. Let's go through the highlights. Monthly cash flow. PFLT pays dividends every month. That's ideal for investors wanting steady income. Floating rate advantage. With most loans tied to variable interest rates, PFLT has actually benefited from the recent high-rate environment. Secured diversified portfolio. About 90% of its loans are first lien secured, meaning PFLT gets paid first if a borrower defaults. Plus, the loans are spread across nearly 160 companies in different industries. Consistent dividend history. PFLT hasn't cut its dividend in years. It's maintained about 10 cents per share monthly, showing strong consistency. Of course, there are risks. High payout ratio. PFLT pays out nearly all of its earnings as dividends. If income dips, there's little cushion. Economic risk. If the economy slows and small companies struggle, loan defaults could rise. Stock price volatility. BDCs can swing in price based on credit market sentiment, so expect some bumps along the way. Still, for investors who want monthly income and can handle some volatility, PFLT offers one of the most reliable and generous payouts in the market. Like, share, and subscribe for more.